Okay, we're going to look at exercise 5-5, the Hira company. And as you can see, we've been given a balance sheet, and we got some issues. One thing, it doesn't even have the retained earnings. But another issue is that just there's a lot of things that are not presented correctly. So what we need to do is as it says in the instructions, prepare a revised balance sheet. And then we were able to, they gave us some additional information, which you're going to need to know: accumulate depreciation, allowance for doubtful accounts, and then some other stuff that's going to be helpful. Okay, so let's look at the current assets first. So we have cash, receivables, inventory, and equity investments. If we go to the to how the balance sheet should look, the cash is fine, and then the equity investments are fine. They should, as far as being situated in the current assets. An equity investment means that your company has an investment in another company. So maybe it owns stock in something like, I don't know, Microsoft. I don't know. So owning stock in another company would be their equity investments. And these investments, how we value them? Well, that's going to depend, and in this case it depends upon whether or not, one of the most important things it depends on is whether or not it's ready to be traded. In this case, these equity investments are trading investments, meaning that they're ready to trade them. They're considering selling these investments off at any time. And the nice thing about equity investments, especially if it's publicly traded, is we know what they're worth. If you want to know what the value of Microsoft stock is worth, you could just look on your phone and know what it's selling for right now. So knowing that is an important element to this, since they're ready to go. So since they are ready to go, we can put them at fair value. Now, this is different from stuff we talked about in the past. Let's say, for example, you're thinking about selling, or you're thinking about valuing property. Let's say you have a warehouse. Warehouses aren't easy to sell. Property takes time, and you have to find a buyer, and you have to get appraisals, and there's all kinds of things that go into it. So you can't really get real-time value on a warehouse. You can only get estimates, and the only time you can really know what it's worth is when it's actually been sold. But that's completely different from equity investments that are publicly traded. Those, like I said, you could look on your phone and see what they're trading for right now. So getting the fair value of those is the way that is the way to go with GAAP in that situation. So we want to use the fair value, right? 120,000. So you'll notice that we did that. We changed it to 120,000. Now the receivables were okay, except that they put them at their net. So their net was what they were worth minus the allowance for doubtful accounts. So the receivables, this is the receivables net of what their allowance is. So the allowance is provided down here, 17,000. So what they're saying is, let's go back to the other one. What they're saying is that the receivables are really worth, the receivables were originally worth 357, but what is a receivable? Is something that somebody owes you. So what is it? What is the value that somebody owes you? Well, it kind of depends on what you expect to collect from them, not really what they owe you. If somebody owes you money but you don't expect to collect it, then you wouldn't depend on it, would you? And if, even though we have people that owe this company, or businesses that owe this company 357,000, if we're not expecting to collect all of that, then we don't want to depend upon it. And so the investors and creditors that use these financial statements need to know what to depend on. So the allowance is what we expect not to collect. So we backed into the 357. We knew the net was 340. We knew the allowance was 17. That was provided. So that means the original full amount must have been 357. Okay, so then we have the next one, which is inventory. All right, and inventory is correct. So inventory is a current asset. Any asset that we expect to convert to cash or to be used within a year would be a current asset. And but there's another asset that we have. If you look down, prepaid expenses. So if you prepay for your insurance, if you prepay for your rent, then that is an asset to you. If I were to pay for a year's worth of rent on my business, then I wouldn't have to worry about that for an entire year. So that's a resource for me because I have my business set as far as location for an entire year. So as we use it up, as we use that prepaid rent up, or whatever this is, we don't know if it's rent, but let's just say it is. As we use it up, it becomes an expense, a real expense. So a prepaid expense is a resource, and since we rarely ever pay for something for more than a year, we usually don't pay for things for long period, prepay for something long period of time. It almost always sits in the current assets area. So we'll see here that the prepaid expenses were moved into current assets. So the next thing we have is long-term investments. Okay, so long-term investments. Let's look at how it's originally. Okay, long-term investments. Let's see. Well, let's see what they provide us. They provided us with property, plant, and equipment. That's not a long-term investment. That's going to have its own area. Property, plant, and equipment is only buildings and land and equipment that you have that's in your operations, that's currently being used. So if you were building cars, the factory that you're using to build cars, the warehouse you're using to warehouse cars, the equipment you're using to, those are property, plant, and equipment. If you bought a warehouse, but you haven't put it into use, maybe you're not sure if you're going to use it or not, or maybe you bought some land and you're saying, well, maybe we'll build a factory there one day. That is not property, plant, and equipment. That's going to be a long-term investment. And then we also see in the intangibles, they have cash surrender value of life insurance. For key employees, a company will often have life insurance. So you can imagine somebody like, some key employees like Zuckerberg, for example, at Facebook, or another example might be Elon Musk of the Tesla car corporation. Those guys in particular are kind of central to their organization sustaining itself and lasting. So they may have life insurance on those key employees. So that's common in businesses, and so this again should not be an intangible asset. We'll talk about that in a second. Well, let's talk about now. An intangible asset would be an asset that we have that's got value but no physical presence. So intangible assets are stuff like copyrights or trademarks. The trademark Nike swoosh, for example. Cash surrender value of life insurance is not considered an intangible. So instead, we'll put that over here in the long-term investments. So the land and the cash surrender value. Property, plant, and equipment, again, that's going to be stuff that's used in its own in the operations of the organization. So I'm going to actually stop here and do part 2 in a separate video.